This is the Rich Dad StockCast with Andy Tanner, the show that kicks 401ks in the asphalt and teaches you to be the master of your own stock investing domain. And here's your host, Greg Arthur.
Okay, welcome to the show. Today, you're going to hear something that you have never heard before. But first, I want to tell you a quick Robert Kiyosaki story. The other day, Robert said to me, if you're the smartest person in the room, you got to get out. And, you know, me being his employee, I saw this as an opportunity to kiss his butt a little bit. So I said, but Robert, that's impossible for you. You're always the smartest person in the room. He stares at me like I was just too stupid and too pathetic to acknowledge. So clearly my butt kissing didn't work. But he says, Greg, if you're the smartest person in the room, then that room is your personal coffin, which is kind of a scary thought. Except that I've never been the smartest person in the room, so I guess I'm safe. But he went on to explain that as soon as you think you're the smartest, you stop listening and you stop learning, and pretty soon something else happens to you. And he said, Greg, you know what that is? And I didn't say anything. I was too scared to embarrass myself further. He said, you start to die. If you're not learning, you're dying. And that's why I surround myself with the brightest and the smartest people I can find. So podcast listeners, the whole reason you tune in is to hear from one of these brilliant, smart people, the person Robert Kiyosaki calls for when he wants stock advice, his advisor, Andy Tanner. But wait, there's more. Today, Andy is going to do something that I've never heard him publicly do before. Andy is going to explain the actual true criteria he uses to pick a stock. Yes, the smartest stock person we know is going to share his checklist for determining a great stock. So say it with me, greatest show ever. And with that, let's bring in Andy Tanner and a very special guest. Andy, welcome.
Gee, with an intro like that, that sets the bar pretty high, man. I feel the pressure.
I really practiced that a lot, you know.
I feel the pressure. The magic criteria, huh?
Oh, yeah.
Today, if it's all right, I've invited a little guest to come along today. This is my son, Zachary. So say hi, Zach.
Hello.
Hey, Zach. We're glad to have you.
He's really verbose, let me tell you. He's the king of the one-word answer. Yes, no, maybe. But hello. It's supposed to be like, yeah. Oh, great. Thanks for having me.
Yeah,
hi.
Thanks for having me.
Yeah, that's how it goes.
Hi.
But Zach, how old are you?
I'm 14 years old. 14
and getting ready, just kind of in the middle of junior high school. And this year, we'll tell them our plan. Tell them what we're doing.
I'm going to sit out a year so I can
get
knowledge.
Gain knowledge. So we're going to
wait. You're going to sit out of school?
Yeah. We're going to do homeschool. Yeah.
I love
it. A whole year of nothing but financial education. Like we're going to put like, are you a pretty good student? Brag a little bit.
Yeah.
Was I a good student?
No.
No, I was not a good student. I barely kept my C- to play basketball. But Zach is a straight A'er, straight ace his whole life. I don't think you ever got an A- in your life, have you?
I don't know.
I don't think you have.
Maybe
in
I can't
elementary
remember
school?
elementary.
I don't think so. But he decided he's going to put his academic pursuits on pause for a bit, and we're going to do financial education, homeschool.
Wow.
So part of that is a couple of things. Number one is right now he's taken my class called the 4 Pillars of Investing. He just finished fundamentals. Is that right?
Yep.
Is that where you're at in there?
Yeah.
And he's taken like everybody else, and we talk about it after, whatever. And then we're doing some real estate courses, and we're doing some tax courses from Tom Wheelwright, Rich Dad Advisor, a little plug for Tom. Right. And then he's going to shadow me in my education business about an hour a day and trade with me. So part of that shadowing in the education business is learning how to do a podcast. So today is how to do a podcast. And it'll be good to have him here because me and Greg, we're figuring it out on our own. So this is good.
Yeah, hey, I have no idea how to do a podcast.
So we're grateful to be here, and we're grateful for the topic. Last week, Greg, just catch you up, Zach. Greg and I and everyone listening, we were talking about stocks that pay dividends. And those are stocks you usually want to hang on to for a bit, just like the real estate we have, right? We've had real estate for many, many years. And what do you like about, talk a little bit about the real estate. What do you like about real estate? Are we flippers or cash flowers?
We're cash flowers, so we rent houses.
What's the difference?
Well, So a flipper is when you buy a house and rehab it to make more money off of it, to sell and make more money off of it. And cash flow is when you buy a house and maybe do a little work on it and get some cash flow and get rent.
Renters, that's right. So stocks, what's the difference between flipping a stock and cash flowing a stock?
So like flipping a stock is like selling, like buy low and sell high, kind of like that. And cash flowing a stock is having dividends, holding on to that stock and have the company pay a dividend. So,
when you hold on to stuff, it's like a little box, a little jack in the box that cranks out cash. So last week we talked about, some dividend stocks, and we had a great discussion. And Greg was saying, hey, so how do you choose one of those, right? How do you pick one? And I'll just hop in here, and Zach, you can add to it if you want, but I would say this I'll just share an experience, Greg. When I first started this years and years ago, the way I got involved in this type of education, I was a salesman. And in the 90s, the internet comes about. They say Al Gore invented the internet. I don't think that's true, but he claimed victory for that.
Right.
And now you could do this online trading, and everyone was a stock trader all of a sudden. Everyone was a day trader, and you could throw darts at a list of stocks on the wall and do well. And so in learning the software is where I started learning about this. Now remember that's the first time you could really search for criteria, right? Where you could search and say, oh, I want a stock that does this, that, and the other. And one of the problems and traps I fell into way early, was too many choices.
Yeah.
There's like 14,000 stocks to choose from. And what the problem is as soon as you get a lot of choices, people freak out because they feel like they're getting married. Now, when I got married, I was picky, okay? I hopefully she doesn't discover what an exit strategy is, or I'm toast. But and I can understand marriage rightfully picky, right? But when you have a stock, what do you think the chances are that you're going to pick the very best stock out of all 10,000 choices? It's very, very small, no matter what the fundamentals are.
Right.
So the first thing I'll say in criteria is when I give a criteria out, it is not a magical pixie dust prediction. It says, oh yeah, Andy picked that, so it must be going to be a winner for sure. I will say right now that I have picked many stocks. I couldn't tell you how many where I did the fundamental analysis. It looked good and it didn't work. Look, 50% of people that do the wife thing, decide not to, and 50% of the women that do the husband thing decide not to. So no matter what your dating process is, understand there's, how many pillars are there? 4 pillars. But this is just one of 4 things we do. And one of the 4 pillars is risk management, which means if things change, we're gonzo. So let's start while we talk about this criteria of having a context that where you skip over the problem Andy had. Because at first I made no decisions because I felt if I'm not making a perfect one, I won't invest at all. Does that make sense?
Yeah, it absolutely does. And to further your point, there's not one stock out of the 10,000 that are good. There's multiple. There's multiple stocks. There's also multiple bad.
Opportunity in real estate is the same thing. It isn't like I need the housing complex to invest in the United States or the world that is the best one. No, housing is housing, right? You want to have a good one. So when I go to get ice cream, I laugh because I see people, even with ice cream, getting caught in that trap where they think, can I have a little taste of that? No, but can I have a little taste of that? And I'm just like, hey, it's ice cream. It's all garbage. We're all going to get fat eating it. Chocolate's good. Fudge is good. Strawberry shortcake is good. Most vanilla, that's what you like.
No,
what do you like?
I like chocolate.
Chocolate?
I like, what is it called? I can't remember the name.
Well, you must not like it that much under pressure.
Well, it's because I don't have it a lot. It's
Yeah, Dad. Hey, Dad.
You can tell who's eating the ice cream around here. So just pick an ice cream, right? And one way to know if I get that ice cream cone, I buy it and I walk in, I'm like, well, maybe now I know, right? Next time I do something else. So one of the first things I would say is when we're going to look at a stock, we want to see if we want to be an investor or a trader. And there's a wonderful book by Benjamin Graham that talks about the difference. And he says in that book, and I agree with him, it's okay to do both, but you need to know when you're doing one and when you're doing the other. So in this podcast, we're going to talk about stocks that we want to hold for a while, that we prefer to hold for a while. Now,
that's what an investor is, right? An
investor, yeah. And, investor trader, if I put money and I feel like I'm investing something, and if I buy something, I've made a trade. So this term investor trader, I'm going to go to the New York Stock Exchange. I'm an exchanger now. So the words are semantics, but we're going to say, look, we're going to invest in something we hope will be there. Now, there's this idea of buy, hope, and pray, and we don't want to get caught into that. If I have a business that's failing, I'm leaving. Warren Buffett just sold all his airlines during coronavirus. So anyone that thinks that he holds a stock until he dies, well, he didn't die, but his relationship with Delta Airlines did. And that was like probably the 5th largest holdings he had. I mean, he really got rid of it because he says, look, it's not a business I want to be in anymore. It doesn't cash flow. I'm leaving, right? And they cut their dividend. Right. So, obviously they cut it. They eliminated their dividend. He's like, well, I don't want to have a box that doesn't pay me. I'll go find a different box.
Right.
So just because he did a fundamental analysis on Delta before he bought it and it fit his criteria, whatever it is, doesn't mean that it's going to be guaranteed for the next 30 years to work. He stayed away from airlines for years. I think he bought his airlines maybe 5 or 6 years ago. So he held that stock 5 or 6 years. That's it. I think he bought it in 2015.
Is part of the lesson here, and it's probably not even what you're aiming at, but what I'm gleaming is even after you bought the stock, you don't stop doing your fundamental analysis on the stock. You have to continue to do that. Is that correct?
I love it. If it doesn't keep up to snuff and keep performing, then we're probably going to take our money elsewhere and take our lumps and learn how to hedge and learn how to exit, okay? However, when you get a dinger, when you get one that's really good, you'll probably hold on to that stock. I don't think Warren Buffett will ever sell his Coca-Cola because his cost basis was so low.
Yeah.
So let's talk. So with that kind of big picture idea, let's talk about what type of companies that I like to look at, and someone else is free to develop their own criteria. I like chocolate ice cream. He likes chocolate.
I like chocolate. It was cookie dough.
Cookie dough.
Oh, yeah.
So, and I don't like cookie dough.
What?
But because I don't like it doesn't mean he can't enjoy it and have it for himself. So understand, this is not a secret sauce. Let's begin with the first thing we do. The first criteria is we want to have a stock that has really solid fundamental analysis. And now that's a fancy word. So what does that mean? We're trying to find value. And what happens sometimes is stocks get detached from fundamentals, either overvalued or undervalued. Let me give you an example. Tesla. Tesla is not on my list because they don't pay a dividend yet. It's pretty expensive jack in the box just to hope for growth. So people that are in Tesla right now, they are trying to buy low and sell high, right? They're trying to flip Tesla. And that's tough because I don't know where Tesla is going to go. I don't know where the stock chart's going to go. And you've seen them have a lot of volatility. And I'm convinced that Tesla has not had that much volatility in their sales and in their earnings and in their fundamental financial statement. This is speculation by investors. So for a dividend stock, and we're not looking for a Tesla. We're looking for something that pays a dividend, number one criteria. We want something that's going to pay us. Buffett has a couple of companies. You tell them about the analysis you did on Buffett the other day. What was the exercise? Tell them what I had you do.
So I made a spreadsheet that had all the dividends, like the dividend stuff, and I did all of the companies on the list that you showed me.
Yeah, I gave him a list. I said, let's study Warren Buffett. And I gave him a list of all of Warren Buffett's holdings at Berkshire Hathaway, and I said, I want you to, how did you find the information? What'd you do?
I went on the NASDAQ and
NASDAQ.
NASDAQ and clicked on the stock and see the dividend history.
So he put in the dividend of every single one, and one of the ones we found on there that we kind of liked was Wells Fargo.
Yeah.
And the reason we like Wells Fargo is,
Paid a
if
good
you remember,
dividend.
paid a really strong dividend. It was like, I want to say 9%,
Yeah.
8-9%, because the price had fallen so low that now the dividend, that's, 10% right there. Now, they could cut that dividend.
Sure.
And they could lower that dividend. They could eliminate that dividend. Because of coronavirus, I said, son, let's see if there's any stocks that have not rebounded well. And one of them was Wells Fargo. Now, first criteria, pays a nice dividend. Okay. Second criteria was, are they going out of business next week? Probably not, right? It's a brand, U.S. Bank, Bank of America, American Express, Prudential. These are financial banks and insurance companies that have pretty good brands that are pretty big. I think it'd be tough to put them out of business. Also, the government doesn't like big banks going out of business. They tend to provide backstops. I always ask Kenny Macro, I go, what happens if there's a recession? And I asked Kenny this 5 years ago. I go, what happens if there's a recession? Everyone loses their job, and no one can pay rent anymore. He goes, government will subsidize them. They want people paying houses. Here we are.
Yep.
Right?
Yep.
Here we are. We missed in all our real estate, our personal holdings. None of our tenants missed a rent payment, and in our holdings and syndications, we had one shut down for 2 months, and they're back paying a distribution now. So it can happen in real estate. It can happen in stock. So the first criteria was, does it pay a dividend, and is it decently priced relative? Is it a bargain for the dividend? And then number two is, do you think they might be around for a while?
Is there a ratio on the first one that you're looking for, like dividend to price?
No, I mean, there might be, it's really interesting because the lower the price goes, if you look at a stock chart, companies that pay a dividend take pride in how many consecutive years. I think ExxonMobil has raised their dividend for 35 years in a row. That's like 1980 something, probably 30 years ago. Is that what it is? 1990?
Yeah, it's 2020 right now.
Nice math, thank you. And so we got the A student math here, right? So, I'm 18 years old back then. And so ExxonMobil actually lost money last quarter, but they actually borrowed money to pay their dividend. They actually issued some bonds just to keep that streak going, just to keep their shareholders happy.
Right.
So I care a lot. Do I have a certain threshold? Not really, because let's say they're only paying 2%. Well, just like we talked about last week, if I really like the company's fundamentals, and there's something called a payout ratio, and you looked up that too, didn't you? The payout ratio, do you remember what that is? I mean, you only went through it last week. It might be new for you.
Yeah, it's a little.
Okay, so the payout ratio is, I get the total earnings. Here I am with the company. Here's my, what we call the bottom line, or the net income. And we say, what percentage of that are we going to give the dividend? That's the payout ratio. So if the payout ratio is like 30%, that means that they got 70% of that money that are retained earnings, putting into R&D, reinvesting in company for growth, making stronger, and yet they're still paying. And it also means they have room to keep paying that dividend, right? So that's an important criteria, and I like to see a nice payout ratio. Some of them are over 100% right now, though. Yeah. ExxonMobil's went over 100% because they're having to borrow money to pay their dividend.
So traditionally, though, that would be an actual negative. Like, you don't want the dividend payouts too high because then the company's not going to grow.
And they say, look, we can't afford to pay this dividend anymore, right?
Right. They can't keep it up.
So the lower the number, the better. The lower the payout ratio is, the more strength and room that company has to maintain that dividend. Okay. So the more important thing is, am I buying a business that I like? Because if I'm buying a business that I like, and I'm buying a business that makes sense to me, I'm going to bet on inflation, just like Kenny Macro will bet on inflation to say rents will go up. Like, do you believe, Zach, that the price of a can of Coca-Cola will be higher in 10 years from now or lower?
Probably higher.
Higher, because Why would that be? Why do you think there'll be inflation?
Because the government's printing money.
The government's printing money, which means the value of the dollar is going where?
Down.
Down, which means the value of goods and services will go
Up.
up. Well, that's true with a can of Coke. That's true with, whatever else it is. So you look at Warren Buffett, who bought Coca-Cola at $3 a share. Now the dividend's $1.60. That's why fundamentals be damned, technicals be damned. Everything now is like, that's cool stuff, right? So you're really thinking long term, saying, hey, that dividend, even though it might be small today, someone poo-poos it. Oh, that's 1%. Oh, that's 2%. Like Uncle Frank, right? Oh, that's 1 or 2%. Yeah. Well, okay, hold on to that for 10 years and see where it is. You might be getting a dividend of 20%, because it's not the dividend yield, it's the investor yield that matters. So when it comes to fundamental analysis, what are some of the things we want to look for in a business? What would you say?
Enterprise value over EBITDA.
Yeah, enterprise value and EBITDA. Yeah. Now that's fancy words, so that's a little more advanced. So enterprise value it's a lot like real estate, where I say, hey, what's this property worth? It's a lot like cap rate. What's this property worth? What's it gonna give me back, right? EBITDA is an earnings number. So you can use earnings, PE, EV over EBITDA. There's a million you can choose that get all wonky, and that's what we teach in the 4 pillars of investing. That's really a discussion for the 4 pillars. But basically, we want a company that earns money and that is growing. How simple is that? Okay. If you read the book by Benjamin Graham, who is Warren Buffett's mentor, The Intelligent Investor, it has 2 types of intelligence. First is emotional intelligence, right? Don't invest when you're trading, and don't trade when you invest. Know the difference emotionally. And then secondly, it's not a lot of securities analysis in there, but what securities analysis is in there basically says, look, we look for 2 things: a company that's earning money and a company that's growing. So don't think, again, there's some secret sauce to this. Have I seen growth over 2 or 3 years in a row, maybe 4 or 5? And have I seen earnings that they're actually making money over that time so they can pay me a dividend? I mean, that should be pretty simple for everyone to understand. Oh, if I were going to buy a business, what would I want? I would want a business that is profitable and a business that is growing. Those are the 2 most important things. And so, Zach's been in the 4 pillars, and he's learned about enterprise value, which is, what's the company worth, and EBITDA is how much money are they bringing in, right? That's one of the ratios we can use. There's also a PEG ratio, which is price, earnings, and growth. And so those types of numbers, we want to have numbers. Now, you say, Andy, what's a good number? And everyone wants a recipe, right? Give me the number. We do a little of that in the 4 pillars, but for now, this is what I would say. How do I know something is good? The best way to know is by comparison. When you go to the grocery store into the produce section and you're going to pick a watermelon, what do? Well, I don't know what you do. What do you do, Greg?
Oh, you're right. I pick up a bunch of watermelons.
Yeah, you thump it, and it's really not a certain size or a certain weight you're looking for. It's like, which one sounds better? And we fake it because we don't know how to pick out a watermelon, but we're thumping this one and thumping that. Well, this one deeper than that. Let's buy this one. So it's by comparison. So I might say, let's go into an industry like we looked at Wells Fargo, like banks. And we might say, well, what are their earnings compared to other banks? What is their growth compared to other banks? And pick one that is doing well relative to their buddies, right? This is a lot like when The Bachelor, she's sitting there and those are the bachelors, and, maybe none of them are good choices. Maybe all are good choices, but she's comparing one to the other, isn't she? She's trying to find her Prince Charming by comparing one bachelor against the other bachelor. That's the way we do securities analysis is, what is in a recession, they might all be doing terrible. And so we say, okay, well, who's the least worst in the terrible time if we're investing, which can be a nice thing because prices might be low. Does that make sense?
Yeah, you said something there that I didn't know. Okay, everything you say I don't know, but we started out, there's 10,000 stocks, right?
Yeah.
And you don't have to pick the best one, but what you just did is you already minimized it. So when we're trying to figure out the best one for us, we're comparing stocks by their categories. Not just, is this the best stock out of all 10,000? Because that's the impossible question, right?
That's exactly right. I'm going to bring this up. You guys won't be able to see this, and you don't need to. But I'm going to go to Yahoo Finance. And Zach, you've seen this in the 4 Pillars class, but you've never done it before. So we're actually going to do it for the first time together here. Okay. So this is what homeschool at the Tanner House looks like. Cool. So we're going to go to Yahoo Finance, and those that are just listening, that's fine. You know, we can do Yahoo Finance. This is a free, this doesn't cost anything to get this data. You know, one of the great things about investing this day and age is in the information age, you know, information is cheap, right? And you can get wonderful amounts of data without charge. And I have a few websites I do subscribe to. Right here, I'm going to a screener, and I'm just going to say save screeners. And right here, you can see, Zach, one says bullish fundamentals, one says bearish fundamentals. So we're going to go bullish. And all of a sudden, it just runs a search based on the following criteria. And here's the criteria that I'm teaching my son as a beginner that I think would be great criteria for beginners listening to begin to practice with. So the first thing is I've got a region. So I'm interested in United States companies. I like to try it in the United States market. It's the largest market. It's the most liquid market. I like that idea. Number 2, I'm searching for large cap and mega cap companies, mean big ones, because that also means liquidity. I'm looking for big companies. Okay. The next one is I'm looking for a price that is greater than $10. If a stock is only worth $2 or $3, there's probably a reason it's only worth 2 or 3, and that's cheap. But I at least want $10 because if you're not worth $10, you probably suck. And I don't want to look at. And there might be a diamond in the rough I'm missing. You know, don't be like that guy. Oh, can I have a little taste of that? I got to look at all 10,000 because I don't want to miss the opportunity. See, greed is the fear of losing out on the big one. Can you just see it happening? I got to look at all. What if there's one at $9.95 and it's the next Google and I miss it? See, greed is the fear of losing out on what could be. What if I just say, look, get a nice portfolio with a nice cash flow, get a passive income above your expenses, buy business, real estates, and stocks, live happily ever after. You don't need to get the best, oh, I'm going to get the next Tesla, you know, whatever. The next one is what actually you had talked about, enterprise value over EBITDA. So we take the total enterprise value on the top number, we put the EBITDA on the bottom, and we want that to be less than 10.
Okay, real fast. EBITDA was what?
EBITDA is called, well, it's a fancy accounting term. This is for Tom. Stands for earnings before interest, taxes, depreciation, and appreciation, I think, something like that.
All right, so it's basically your earnings. And then what's on the top?
Enterprise value.
Which is?
It's cap rate. Oh, no, excuse me. It's the market cap where they figure in their debts on their balance sheet as well. Gotcha. So let me give you a real estate analogy. If Kenny goes to look at real estate, his biggest number is NOI. You heard of that before?
NOI,
Net operating income.
What is it?
Net operating income.
Okay, so what is net operating income?
It's basically the cash flow without the debt.
That's right. So I get in all of the income without my debt payment. And the reason is debt is kind of debt, and real estate investors want to separate out, you know, certain things because we want to know what the core earnings come from, right? You get the earnings expense of what's that number? Taxes, debt, that's kind of the same for everybody, right? And if I'm refinancing, the debt's going to be different anyway, right?
Okay.
And so this is very similar. It's earnings before what? Taxes, right? Before interest, before we depreciate things and stuff like that. And so it's more of a root number of their real earnings, right? Earnings before all this other crap would be a great way to say it. That's the technical term. It's earnings before all this other crap. That's a good way to learn that right there.
Crap.
That's you go. Earnings before crap. We call it EBC. Earnings before crap. It's the new metric by Zach Tanner. Earnings before all the crap comes in. So then the last criteria we have is price earnings growth, which calls a PEG, and we want that less than 1. So I hit this, bam, and here Yahoo Finance gives me, I don't know, 25 rows here and however many pages. 175 companies right there. I have 175. So I just went from 10,000 to 175. That's kind of manageable. And then what we can do is we might sort this according to which one pays the largest dividend maybe. And then we start looking at stock charts. The final thing is when we look at the stock chart, we want to find something that we think is, if it looks like it could trend down just a little bit more, we'll wait for that good entry price, right? We try to find really good, buying at support, buying it, bouncing off support. And so that's one of the things that sold us on Wells. We said, hey, you know what? We like that bounce. We think that thing has a chance. We don't think they're going out of business. We're prepared to have it go down further and stomach that for a while. As long as we like the dividend, we think they're going to be around. So half of this is securities analysis, right? Half of it is all these numbers. The other half, though, maybe even the bigger half, if I can use an oxymoron, or bigger half, maybe the bigger half is, or the more important half, is temperament and mindset. And what Robert always talks about is big picture context. Knowing what I'm doing, knowing my goals are, no emotions, and acquiring an asset. It's pretty tough to screw up buying real estate in a 10-year time frame. Real easy to screw up if you're trying to flip in 3 months. Way easy to screw up flipping in 3 months. But it's pretty tough to buy a piece of property and then 10 years down the road have it being worth less. Well, it's going to be pretty tough to buy a pretty solid, blue chip type stock and have it suck in 10 years. It can happen, but not likely, not as likely. So a lot of it's just, the bigger decision is, do I want to go buy a liability or do I want to go buy an asset? And the thing that I hope Zach understands is when he gets some cash, that he allocates some of it towards assets around liabilities, and he learns to manage risk the best he can. Again, this is just fundamental analysis. That's all it is. There's three other pillars in addition to this, but most importantly, as we kind of close out the podcast, the most important thing I want Zach to understand is the general philosophy of what I'm doing before the nitty-gritty numbers. What are we really doing here? We're saying, hey, is this a good company that I'd be proud to own? That when I look at its financial statement, I said, yeah, that's good news if I'm the owner. Wow, we're making money and we're growing. I'm the owner of the company. We're making money and we're growing. Yeah, I'm happy with that. So that's a little bit on the criteria we use when we look to buy a stock that might pay some dividends down the road. Anything else you want to say? We're 2 minutes over.
Thanks for having me.
Hey, thanks for being here, man.
Long-winded, see? Thanks for having me. Long-winded. Are you having fun at home school so far? We were going to start in the fall, but we thought, well, we're in control now. Let's just start right now. So we trade stock every day, don't we? We come in, look at the charts. He knows all of Dad's positions, and he's learning. We did a diagonal calendar spread on Berkshire Hathaway the other day. We've got a lot of puts and calls out there.
Yep.
And are you happy with our cash flow? Like it?
Yeah.
You want a cash flow like that someday?
Mhm.
Yeah, I think you do. Okay, so we're just having a ball, and thanks for having us.
Hey, thank you. Congratulations on teaching your son. That's truly impressive.
Well, he's an impressive kid. We're proud of him. All parents show, all the parents are showing you the pictures in their wallet or on their iPhone, so I got to bring mine too. I'm just like any other dad. I'm proud of my boy. And he's got a killer jump shot too, I'll tell you. I can't beat him in horse anymore. I won't play him anymore because he can beat me. So that's it.
Well, thank you both. We really appreciate it. We learned a lot.
Awesome. Very cool. Thanks, guys. We'll see you next week.
See you next week. Thank you.